Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global market reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss why markets are not responding to positive news as much as they may have in the past. Phil, you would think more stimulus and improvement to COVID-19 data would provide some of those tailwinds.
Yeah, based on what we saw last year, wasn't it true? If you got a stimulus bill, if you got better COVID cases, if you got news on a vaccine, any of those three data points would have caused the market to rally really strongly. And what we're seeing this year is kind of the opposite, actually. So we've got basically all three parts of those news in the last week, and the markets have been struggling since sort of mid to late February. And really, if you look at the performance of the S&P 500 for the whole year, it's pretty close to going sideways. So the market is kind of, definitely not responding like it used to some of these really good news data points.
And Phil, it seems to all come back to a rise in interest rates.
Yeah, I think whether it's the interest rates themselves just causing people's valuation models to sort of reassess what's the right valuation for the market, or something underlying that, which is, as the market does grow and become stronger, we're likely to see inflation, and the inflation will lead to the Fed raising interest rates at some point in the future. Whatever the underlying reality is, when you look at valuations historically, the price earnings multiple, so I guess you could think about it as like the valuation of stocks relative to earnings, increases as interest rates go down. We've talked about before how that makes sense from a valuation perspective, because you use interest rates to discount future cash flows as well. And you can see in the data, there's kind of a pretty linear trend. And to your point, with rates going up now almost 100 basis points since sort of the middle of last year, we'd expect the multiple to slide down a little bit, and for valuations to basically have to have more earnings to justify the price levels we're at right now. And so that's where the market is sort of reassessing. We could get more earnings as vaccines roll out. With all of this extra stimulus, we could actually see the earnings keep up with the expectations, but there's also the discount factor that's at play with rates rising as well.
And Phil, as we can see in the next couple of charts here, COVID-19 data continues to improve. So when we think about stimulus, is this a case of too little, too late?
And that's what a lot of economists are starting to talk about. I mean, $1.9 trillion is a huge amount of money to put into the system, especially when, to your point, like the vaccines are rolling out. We've got, getting close now to 20% of the US population vaccinated. We heard last week by May, there should be enough vaccine in the US for every adult. And while that's all happening, we're actually seeing the case numbers come down, people wearing masks, which is helping lead to expansion of restaurants, opening up some of the other industries that have been closed. Airline ticket sales, things like that are actually starting to improve as well. So the COVID data is looking pretty good. If the vaccine rolls out and people can start to go back and consume services, do we really need so much of an injection in stimulus? And that to its, I guess, the end point is maybe going to overheat the economy rather than help us get through these last few months.
Right, and that's exactly what you and I have been talking about for the past couple of weeks. Another thing to think about, the employment report looked really strong this past Friday as well. Is it telling the full story, though?
Not really. So there is a lot of people that have dropped out of the labor force. There's actually a lot of people that have retired early as well. So that helps the unemployment rate, the 6.2% rate that it fell to, look a little bit better than it really is. But also, we've still got that K-shaped recovery. So when you looked at some of the new jobs that came out last week, luckily or thankfully, a lot of it was people returning to jobs in the leisure and hospitality industry, which has been hit really hard. But there's still about 1 million people in that industry that don't have jobs. If you look sort of longer term at where unemployment or the drop in employment is this recession compared to other recessions, we're really only back to about the worst levels that we saw back in the credit crisis. So although we've had a really V-shaped recovery and we're expecting that V to accelerate again as vaccines come out, there is still a lot of people unemployed right now. And they're in those kinds of industries that, to your point, are socially distanced susceptible.
And Phil, at the end of the day, it all comes back to the K-shaped recovery. Anecdotally, and I have a couple of pictures to show you here, I was back at MarketSite Studio last week, and Times Square is not anything even remotely close to what we saw at the beginning of March last year, never mind 2019. As you can see in these screenshots I provided, this was Thursday, March 4th at 3:30 p.m. Eastern. The shot on the left is 43rd and Broadway from the second floor of the MarketSite Tower, and the picture on the right is 42nd Street and Broadway. And 42nd Street is arguably the busiest thoroughfare in New York City. It shows how the recovery is relative in many parts of the country. And Phil, your last two charts support that when we take a look at small businesses, when we take a look at gross Broadway.
Yeah, I mean, it's interesting. We spend so much time talking about the retail spending numbers being better than pre-COVID levels, about manufacturing being better than pre-COVID levels, about shortages and freight rates and commodities growing. But there is another side, and we don't talk about it that much. And some of it's because you don't see it. To your point, if we're not in Manhattan, we don't actually see how quiet Manhattan is, how many of those small businesses that are servicing lunches or whatever in the city have remained closed. But you can see it in some data. So one of the charts we've got here looks at small businesses reopening, and it's been pretty weak ever since the initial reopening, still down more than 20% from pre-COVID levels. And if you want an extreme example of an industry that still hasn't recovered, Broadway, which is classic for the photo that you showed, there's a couple of theaters right there, still haven't opened. So anybody that's in that industry is still waiting for a safe time to get audiences back into the theaters.
All right. Hopefully we're looking at that in Q3. Phil, great to have you with us as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.